Hello and welcome to Ask Bridges Val Show. I host this live on almost all Monday at 7:45 p.m. with an objective to share some personal finance and investing nugget to help my social media community to achieve financial well-being. When it comes to investing, mutual funds have long been a popular choice among investors due to their low cost, diversification, and potential to generate long-term returns. However, many investors, even experienced ones, make mistakes when it comes to investing in mutual funds that can significantly reduce returns. In today's live, we are going to discuss about most common mutual funds investing mistakes and how you can save yourself from same. So without further delay, let's jump to the discussions. In this live, we will discuss the most common mutual funds investing mistakes to help you avoid them. I will explain how to determine the right mix of funds for your portfolio, how to avoid over diversification, and much more. By understanding the common mistakes investors make when investing in mutual funds, you can avoid them and ensure your portfolio is well positioned to generate the best possible returns. So let's get started and explore the common mutual funds investing mistakes and how to avoid them. Mistake number one, not diversifying your investments. One of the most common mistakes investors make when investing in mutual funds is not diversifying their investments. By diversifying your investments, you are spreading out your risks. This means that if one of your investments does not do well, your portfolio will not lose its money or you will not lose all your money. Diversifying your investments also helps you to benefit from different types of investments. This includes shares, bonds, international investments, and much more. Having mix of investments in different sectors and industries can help you to maximize your returns and reduce the risk associated with investing with any one of the investment vehicle or asset class for that matter. Mistakes number two, not understanding the expenses associated with the mutual funds. One of the most common mistakes people make when investing in mutual funds is not understanding the expenses associated with them. Mutual funds come with various types of expenses such as management fees, transaction fees, and sales charges. And this can significantly impact your returns. Many people fail to consider these expenses when they are doing their research, which can lead to them investing in funds that may not be the best choice for them. It's important to understand and research the various expenses associated with a mutual fund before investing in any one of the schemes. Mistake number three, investing in multiple schemes of the same category. One of the most common mutual fund investing mistake is over diversification. This is the practice of investing in multiple schemes of the same category, creating a situation where an investor holds too many funds from the same sector. The result is that the investor's portfolio is not well diversified and which can lead to higher volatility and lower return. The best way to avoid this mistake is to have a good understanding of the different asset classes available and to choose funds which have different investment objectives and styles. Mistake number four, overlooking risk tolerance. Risk tolerance is an important element to consider when investing in mutual funds. Many people overlook these and opt for higher risk investments without considering their own risk tolerance. Before you invest in mutual funds, you should consider the possibility of losses and how comfortable you are with encountering them. That way, you will be able to better allocate your funds to investments that fit your risk tolerance. A good way to do this is to create a portfolio that includes investments of different levels of risk. That way, you can ensure that your portfolio is balanced and that you are not taking on too much of risk. Mistake 5, not monitoring your investment regularly or monitoring on an hourly basis. While it may be tempting to set up your mutual fund investments and then forget about them or monitoring them on an hourly basis, this is one of the biggest mistake investors make. You should be monitoring your investments at regular intervals so to make sure that they are performing as expected. You should be keeping an eye on the performance of your portfolio and making sure your risk levels are where you want them to be. If your investments aren't performing as expected, you may want to consider making changes to your portfolio or selecting different funds. Monitoring your portfolio at a regular interval is key to ensuring that you are making the most of your investments. Overall, when investing in mutual funds, it's important to keep in mind the risk associated with the market. It is also important to diversify your portfolio and not get caught up in chasing past performance. By avoiding these common mistakes, you should be able to maximize your returns and manage your risk. With a bit of research and long term mindset, you should be able to build a solid portfolio of mutual funds that will help you reach your financial goals. That's all what I wanted to discuss today. If you have any questions, you can ask in the comment. I'll be more than happy to answer your questions. If you found this live useful, please share. Thank you for joining. See you next Monday. Bye bye.